this week's market update, diverging fortunes for investors as the gap widens between the US and emerging markets. And the annual Jackson Hole meeting focuses on a concentration of corporate power. The gap between the performance of the high-flying US stock market and its counterparts in emerging markets widened further this week. Wall Street stands close to its all-time high, even as the shares in the developing world moved into bear market territory, with the MSCI Emerging Markets Index falling 20% from its January peak. Attention has focused on Turkey's woes, with a plunging lira compounding the problems of the country's equity and bond markets. But the problem is broader than one country, as a string of developing country currencies and domestic bond markets crumble under the weight of a strong dollar and rising trade tensions. A strong dollar is bad news for many emerging markets because it increases the cost of funding borrowings denominated in the US currency. So, many in the developing world would have been pleased to see President Trump doing his best to talk down the US currency this week, as he commented that he was not thrilled by the Fed's recent interest rate hikes. Fed tightening has been a key factor in boosting the value of the dollar this year, but the Trump administration now clearly has a weaker dollar policy to support its aggressive trade stance. All this has come a little too late for emerging markets, however, which are also vulnerable to falling commodity prices, another consequence of a strong US currency. Copper, a widely watched benchmark, has fallen by nearly a fifth since April, as growth in China in particular has slowed. China has been one of the hardest hit of all emerging markets, and its equity market is now 26% below its January peak. Turkey, though, dominates the headlines at the moment. The country's currency has fallen by a third this year against the dollar, adding to weakness in its main equity benchmark as investors fret about an ongoing diplomatic row with the US, related trade tariffs, and a host of long-standing concerns focused on the increasingly autocratic rule of President Erdogan. With inflation soaring, investors have looked to Turkey's central bank to respond with higher interest rates. But the re-election of the president in June and the extension of his political powers have reduced the bank's independence and pushed the country into a currency crisis that looks likely to trigger a deep recession. Overseas ownership of Turkish assets has tumbled from $92 billion a year ago to about $50 billion today. Meanwhile, the US market continues to ride high. The S&P 500 has outperformed not just emerging markets, but also its developed world competitors pretty consistently over the 10 years since the financial crisis began in September 2008 with the collapse of Lehman Brothers. Indeed, this week looks like marking a key milestone for investors as the bull market that emerged from the wreckage of the financial crisis becomes the longest running market rally ever in the US. On Wednesday, the bull market turns 3,453 days old. That will put it one day longer than the previous record, which ran from October 1990 to the bursting of the technology bubble in March 2000. At today's level of around 2,850, that's just shy of January's peak of 2,872, the US benchmark has risen by more than 300% since its demonically low level of 666 reached on March the 9th, 2009. Some market watchers are not convinced that we can really describe this as the longest bull market ever until the S&P 500 has risen above its January high, but this is quibbling. The fact is that there has not been a 20% bear market correction since March 2009, and that fits most people's definition of a bull run. Opinion is divided on where the high-flying US market goes from here. The length of a bull market is not in itself a good reason for share prices to change direction if valuations are still acceptable and if shares remain the most attractive place for investors to put their cash. The long-running bull is now reflected in significantly higher valuations for US shares than for those in the rest of the world. Ordinarily, that would ring alarm bells, but it's hard to see a reversal of this new status quo as long as Wall Street is the main beneficiary of a flight to safety by nervous investors, and as long as the alternatives, such as bonds and cash, remain insufficiently compelling. The US market is supported by high profits and still relatively subdued sentiment. Earnings continue to be driven by a buoyant economy, high margins and stock buybacks. And with this long bull market described as one of the least loved by investors, there's little sign of the euphoria which often marks the end of the cycle. In the absence of that euphoria, what might stop the bull in its tracks? Probably only interest rates rising too far too fast. The Fed is expected to raise rates 2 more times this year and 3 times again in 2019. This tightening could lead to short-term rates being higher than the yield on longer-dated bonds. In the market jargon, that's called an inverted yield curve. And this matters because in the past, it's preceded both a recession and the end of a bull market. But for every skeptic, there are others who think the bull market could have some way still to run. Although technically the previous record bull ran for just 10 years from 1990 to 2000, others claim that in reality share prices were in an upswing from 1982 to 2000, punctuated by a couple of savage corrections in 1987 and 1990. And, if anything, the divergence between US and other markets has intensified in the past year as Donald Trump has begun to use trade as his principal diplomatic tool. No one really knows what the impact of a full-blown trade war would be on the US, but everyone agrees that for the rest of the world, China and Europe in particular, it will be extremely damaging. That makes the US relatively attractive. Developments on the trade front this week include the imposition of 25% tariffs on an additional $16 billion of Chinese imports to the US. That brings to $50 billion the imports now captured by America's new levies. This is an awkward backdrop for the visit to Washington of a Chinese trade delegation this week, and few observers are holding their breaths for a good outcome. Now, if interest rates and central bank policy look like being key drivers of the market from here, then attention is bound to focus on this week's annual gathering of central bankers at Jackson Hole in Wyoming. One of the biggest events of the central bank calendar, the meeting is always watched closely by investors, and this year more so than ever, as it will see Jay Powell make his first address to the event since taking over as Fed chairman. He's due to speak in a discussion on monetary policy in a changing economy. More broadly, this year's debate will focus on the increasing market power of the world's huge corporations and look at their impact on shifts in productivity, growth and inflation, all of which have puzzled investors in recent years. In particular, they'll look at how low wages and weak inflation have complicated monetary policy decisions. On the corporate front, things get a bit quieter this week as the second quarter results season is now largely out of the way. On this side of the pond, there are still a few big company results to come. BHP Billiton will report full-year results and is expected to present an upbeat outlook on the back of a rising iron ore price. Meanwhile, Persimmon, the UK's second biggest house builder, attempted today to distract attention from a row over its chief executive's pay, although a slowing UK housing market and a reliance on the government's Help to Buy scheme mean that trading fundamentals are also under pressure. In the absence of company results, attention will remain focused on Tesla, the electric car maker whose chief executive, Elon Musk, shocked investors 2 weeks ago by announcing his intention to take the company private. He then worried shareholders further last week by giving an emotional press conference in which he said he was overworked and looking for a deputy to help him run the business. The many short sellers who were burned by the proposal to go private suddenly found themselves back in the money as Tesla's shares tumbled by as much as 8%.